Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. In this presentation, we are going to look at what is the future value of your investment. Say, for example, you're putting in $1,000 per month for 20 years. It could be any number of years. But before I proceed any further, I would like you to bring up this S&P 500 chart over the past close to 30 years, from 1994 to 2020. And as you can see, these are the percentage gains in the S&P 500 over the past 28 or 26 years. And when we actually look at it as what is the percent return over a 10-year period, you see it is 11% between 1994 to 2003 and 7% in the next 10 years, and in the last 8 years it is 8%. So let us keep this real number in mind, because when some of the investment gurus on the internet say, oh, you can get 10 to 14% return in the stock market, they are not talking with realistic numbers. These are the realistic numbers. So let's take, for example, 7% interest. Number two, when you invest money in a stock market, it is a money that is invested after you have paid taxes. So this is not a qualified retirement investment like IRA or 401 or 403 retirements, where it is pre-tax money. But nonetheless, you are using after-tax dollars, and when you invest in the stock market, you have to pay capital gains taxes. Remember, with the average return of 7 to 8% in this S&P, you have to pay a capital gains tax, which could be 20%, or 20 years from now, it could be 30, 40%. We don't know. So we have to take all those things into account. Keeping those things in mind, let us calculate what would be our future value of $1,000 investment per month for next 20 years. So this is a website, investor.gov, government website. I hope the calculator is right. It is right. Our initial investment is $1,000. Our monthly contribution is $1,000. The length is 20 years. Let's put down an estimated interest rate at 4%. I put this on 4%, but it also has plus or minus 2%. I want you to be more practical and realistic when you're investing money over a long haul. Whether you invest money in stocks, municipal bonds, annuities, or any other type of investment vehicle, you have to understand the return has to be stable. That's why I put an average return of 4%. If a return of 4% in a tax-free investment, which is like you see in case of life insurance, that is equal to maybe 6% taxable return in a stock market. So let's keep that in mind. So we have 4% estimated interest with 2% variation. It is going to compound annually. Remember, it is compounding. So when we say S&P 500 is average 7%, it is not 7% compounded on a yearly basis. So that is a key factor. All right, so let us continue here and we calculate this. And this is what we get. At 4% interest, at the end of 20 years, your future value will be like $359,528. If it is 6%, it is $444,634 and change. And if you look at in a table format, and it gives you a much better picture. And you can see here, at the end of 1 year, at 4%, you're going to have $13,040, and at the end of 20 years, you're going to have $359,527. So using this calculator, you can input any number that a stockbroker or any type of broker gives you, and find out what actually you can expect to get, and compare that with what they are giving you as projections. So you become an intelligent investor. So you know what you expect to get at the end of 10 years or 20 years. I hope this has been useful to you, and please feel free to use this website. This is by the government. Also check on securities and bonds, municipal bonds, annuities, whatever. This applies to any type of investment. And please do subscribe to our channel, and we'll bring you another tip on your personal finances in the next video.